Happy Friday, TGIF. Yes, it's a little later. Not only is it Friday instead of Thursday, it's also in the afternoon on Friday. So maybe you've already skipped out for the weekend. If you have, good for you. If not, let's learn something. The Fed met today, or not the Fed met. Geez, sorry, that's old news. Job reports, first Friday of the month. That is part of the reason why we are slowing this out, because we want to make sure that we give you accurate information. Want to have time for the markets to react so that we know what to provide to you for just where rates are. So long story short, rates are up. No bueno. So according to Mortgage News Daily, 6.5, and that's typically with about a point, 0.8 to 1 point to get that rate. So it's about 6.5 for your normal Fannie Freddie stuff. That is up. Here is what's happened. Look at this nasty red on the far right, guys. Remember, red is bad. Like down is bad for us here. It's the opposite. So this is, we wanted to go up. Green is good. And you can see we've had a really good run for about 2 months. And then all of a sudden, not so good. And here on job reports, and you can notice the Fed, which met, what, a week ago, give or take, a little over. It didn't really have a big impact because the meeting minutes, or the meeting was already kind of like baked into the cake, as far as like we already kind of anticipated the cut. They gave us the cut, and the market didn't really react all that much. What they did react to just now, and this is a very bad sign, is you see how much down it's gone. It's now well below the 50-day moving average. That's that black line. So we could see rates move higher over the next week or two. It would not surprise me. And unfortunately, it's a long way down to that purple line, that 100-day moving average. Time will tell, but this is not good. So why did it move so much? Well, basically, the job reports that just came out, it was 254,000 jobs created versus the expected 140. So that is a lot more jobs. Not quite, but almost double. That is crazy. Plus, there was a revision made that said more jobs were created than recently reported. So that's not great. And then the birth-death ratio, for the first time in a long time, they've actually made it to where it hurt these numbers that we've seen over the last year, 2 years. Those numbers were really bad. So it's interesting here that this was overly aggressive towards the other side of the pendulum now. You can see down below where the jobs came from: government, health, leisure, hospitality. Leisure, hospitality, I mean, they say so, but kids are back in school. Summer's over. I don't understand maybe how that many jobs were created, but we'll see. And so here's some other numbers that don't make sense from what they gave us. So 430,000 jobs were created. Check it out. Of that 430, 230 of them, so half, more than half, are created by 16 and 19-year-olds. So 16, 17, 18, 19. So kids typically in high school. School's back in session. I don't understand where all these jobs are if kids are back in school. And then you see the U6, it shows unemployment going down, went from 7.9 to 7.7. Now, that's not the headline one. The headline's the U3, but U6 is when you take into account like everybody, not just the folks looking for jobs. But the headline one you're going to see is 4.1. So it's down from 4.2. I just don't buy it. And again, the 16 to 19-year-old, they're not getting big jobs that are going to have them buy a house anytime soon. So they're not getting the high dollar. So I don't know. I mean, you can say that the market's reacting like, oh man, this is a good job report. I don't think it is, but there you go. So what does that mean for the Fed? The Fed's projected, supposedly, most things I see, to cut another, they thought maybe it's 50 basis points at the next meeting. Maybe it's a quarter. Time will tell. Who knows? With this jobs report, it might have some chatter coming around like, hey, with this hot of a job market, maybe they don't cut as much. We'll see. But that's kind of the impact of what today had. And that's why you see rates reacting the way they did. So here's some just fun notes. Freddie Mac shows that house prices are still positive. The one on the right looks really messy, but the one on the left, the chart on the left, anything above that black zero means it's a positive increase. So when you see all the headlines like house pricing change and whatever, look, at the end of the day, it's still positive. Yeah, it's not what it used to be, and that's okay. We don't want it to be 15% appreciation. That's just crazy. So anyway, these are the house price index. House prices did decline in some areas. I'll show you that chart in a second. But the investors, I thought this was interesting. Investor purchases are down 50% from the peak in 2021. And just in the last couple of months, they've gone down about 5%. I went to a thing last night and saw one of my buddies who does investors. He does hard money and other stuff. He said the last couple of months, there's been a noticeable drop off with the investor community. So I just thought that was interesting, and that matches this data. This was cool. Look at Dallas. So for these investors, overall, the purchases The light blue is the non-investor purchases, and the blue is investors. It looks like Dallas, Houston are number one and number two for the biggest markets where we're seeing this. So I don't know if that's good or bad. It just is. But that was really interesting. God bless Texas. And as far as vacation homes, second homes, things like that, they are hitting a low for multi-year low. So that makes sense to some degree with uncertainty in the economy, all that other stuff, election, all the excuses, high rates. You can see that the second homes, they went nuts during COVID. Look how much more. That's the part I found interesting is that red part. How much more second homes, vacation homes are bought than primary homes during COVID, which is crazy. So now reason would tell you that, the people that wanted one got one. And maybe that's why we're lower than the normal trend. Equity gains, I kind of talked about this earlier. So in Texas, minus $3,000 for the average price home. I don't know what it is here. Call it north of 400. I'd see that more as flat, but you could look at California, Washington, who knew Montana, but California makes sense. They've been getting hard. Washington makes sense. They've got hit hard. In Maine, go Maine. I remember them being in a previous report, but I thought that was really interesting. Texas, for the most part, flat. And then from what I can tell, Texas is the only negative $3,000. So look at that. Equity gains. Here's some more data just to put it in the charts. Again, as we talked about Texas, while we were -3, Sugarland, Houston, Woodlands, they're getting some love right there at number 4 for the negative equity share. But beyond that, let's see what we got. New home sales. My builders out there, we know you're hurting. We love you. We do. We love you. New home sales fell in August about 5%, 4.7. And lastly, just to show the refis, you can see the recent refi uptick. We told folks be ready because when the Fed hits, rates did drop a little bit, but then they've gone back up. I don't think it's not going to be a straight line down, folks. So I would just say, if you haven't already, reach out to us. Let's run a scenario. Let's figure out where it makes sense. And then when the rates do get there, let's lock, because they don't always stay there that long. So now the fun stuff. Zillow, they're now reporting flood, wildfire, wind, heat, air quality, etc. So good for them. I just thought that was interesting. I don't know where they're getting all that data from, but that's a lot of places to get their data from. Apparently First Street's climate risk financial modeling. Good for them. Out of state, I thought this was really cool. Look on the right. There's a couple of states. Texas, the middle right. It's white because this is showing where people are leaving. So who knew people are leaving for New Mexico, Oklahoma, Louisiana? We're leaving, but they're not leaving far. California, similar, right? They're leaving. They're going a little north, a little east, but after that, it kind of dies down. I just thought that was really interesting. How when people move states, I would not have guessed it would have been like that close from one to the other. And lastly, this is mostly funny to mortgage people, but it's still funny. He says he needs an underwriting exception. Super funny. So you guys know what to do. Let's get social. Let's enjoy the weather. Let's enjoy the weekend. Share, subscribe, forward, all that fun stuff. As always, hard ask here. If you need help with your refinance or potential refinance, call us. We'll run the numbers. We'll make sure you know what you're looking at. And if you got friends or family that need that help too, let's do that too. Take care of your friends. Don't let friends close with non-mortgage mark lenders. There you go. Have a great weekend.